welcome to another video. In the previous video we spoke about options a bit, and in this video we are going to dig a bit deeper into options. So before I begin, let me just show you a chain. So what you can type is option NEC option chain, and you can open the first link, and this is how an option chain looks like. Let's take an example of a stock, Infosys. So let's search for Infosys. Right. So as I said in the previous video, there is a strike price and there is a premium price. All these are strike prices. Now I'll show you how an option contract looks like. First, let's check what's the price of Infosys going on. Right, so Infosys has a stock symbol INFI, INFI. So the stock price of Infosys is 1333.80. All right. Now let's search for an option contract. So INFI. The next thing you type is the expiry month. As I said, there are 3 expiries: current month, next month, and far month. So let's just take current month, which is April. So first the name INFI April, and next is the strike price. So let's just say 1340, right? And next what you write is it's either call option or put option. So here let's just take call option. This is how the option contract for Infosys, expiry April expiry, 1340 the strike price and call option looks like. And this is the premium price, which is 60 rupees at the moment. Now that you know how a contract looks like, let's talk something called moneyness of option contract. All right. So this has 3 constituents: at the money, in the money, and out of the money. So as you can see, Infosys right now is 1333. So let's go back to our option chain, and if you see here, the closest strike price to LTP is 1340. So this would be your ATM, or at the money. Let's understand the option chain properly. The left side are your call options and the right side are your put options. So 1340 is your ATM. In call options, anything above ATM, you say 1320, 1300, 1280 is your ITM, in the money. Anything below 1340, say 1360, 1380, 1400, anything is your OTM, or out of the money. If you are considering put options, anything below ATM, that is 1340, anything below 1340 is your in the money ITM. So 1360, 1380, 1400. Anything above your ATM input options is your out of the money OTM. As you can see, ITMs are always highlighted in yellow color, so it's easier for you to identify ITM. So whenever you are buying a contract, in the money contracts are usually very expensive because the price has already passed that value. All right, and any fluctuation to the price, let's say if the price is going up or if the price is going down, the premium price would also be that volatile. A slight upward movement in the stock price would take the premium price very high, or a slight downward movement of the price would take the premium price very low. Because in the money is so volatile, you can make big profits in shorter duration, and that is why in the money contracts are generally expensive. When we talk about out of the money, the premium price is not that volatile, right? The deeper you go in out of the money, the prices would be that less volatile. You know, the prices would go up or go down when the stock price really goes very high or really goes very down. And because these are less volatile, out of the money contracts are generally cheaper compared to in the money or at the money. So we have discussed moneyness of option contract in this video. In the next video, we will discuss how the premium price is calculated. Till then, take care. Cheers. Bye.